So we first got interested in this subject back in 2009 when, while much of the world's attention was focused on the debt crisis in Europe, a similar crisis was happening in the US and flying a little bit under the radar. Right? So in California and later on Illinois, the borrowing costs of their state governments weren't up to the kind of levels we were looking at for Spain and Italy. And so we wanted to understand what was going on there. And the closer you look, though, the more you realize that there were actually a lot of differences. In Europe, the crisis occurred after the countries had started borrowing even more from already high levels. In the US, they hadn't borrowed that much and debt levels hadn't changed. Also in Europe, we saw this tremendous spillover to the private sector there, where private corporations also found it much more expensive to borrow. We didn't see that in the US. So we call that, the European crisis, an external crisis, whereas the States in the US, it was more like a public debt crisis. And then we wanted to compare that to Canada, which had no debt crisis, despite looking in many ways a little bit like Europe. One of the kind of key facts we focused on was that even the largest non-financial corporations, the guys who were big enough to borrow in a European-wide market, they experienced an increase in their borrowing costs. And that led us to think about kind of things like the risk of government interference that might affect their ability to repay those debts. And by that I mean the risk that a country would leave the Eurozone and redenominate debts into some different currency, the drachma, for example. Or it could be the imposition of capital controls, like eventually did happen in Cyprus, or it could have been some kind of debt relief legislation that might have been passed. Private borrowers in the US and Canada are protected from these kind of things, starting with the constitutions of both countries. In Europe, however, the protections are a little bit weaker. You can't change legal tender, except you can leave the euro. And there are provisions to introduce capital controls and to interfere in property, private property, whenever there's an emergency or it's on the grounds of public interest. So you don't have the same kind of constitutional protections there. In order to protect yourself from government interference, you need to start with a strong constitutional set of protections, much like in the US and Canada. But you also have to build on that with national bank or uniform bankruptcy laws, uniform securities laws, and uniform banking regulations. If the banks are regulated by the countries themselves, the countries have a lot of tools in which they can interfere in debt contracts, and they may have a greater temptation to interfere if they're on the hook for a bailout in the event that a bank goes bad. Basic lessons for those people who are thinking about designing or redesigning an economic union. The first is you need to protect private debt contracts from government interference, and that means starting with a constitution that protects it, augmenting that with uniform laws. That's number one. Number two is you need to think very carefully about how you want to constrain the ability of the member states and their ability to borrow. Right? So we talk a lot about fiscal flexibility, the ability of a state to change its taxes, its spending, its debt levels. In the US, the states have given up a lot of flexibility, and that means they can't borrow very much, but they still get into debt crises. In Canada, the provinces have a ton of flexibility. They can borrow an enormous amount. They don't get into crises. So you need to think about how you want to constrain governments, if at all, noting that just merely keeping them to low debt levels won't protect you from the risk of a crisis. And the third thing is you need to be careful about how you sequence reforms. If you are to go ahead with banking reforms and to open up capital markets without controlling for the risk of government interference, we show that that can actually lead to greater borrowing by the private sector, over-borrowing, and a greater risk of crises in the future.